Meantime, CNBC went back into the field after the U.S. and China reached a deal to temporarily cut tariffs to find out if recession expectations had changed. Our Steve Liesman joins us now with the findings. Interesting, Steve. What'd you find?
Yeah, hey, Melissa, after that agreement to the U.S. and China, a trade agreement of sorts, we went out with our CNBC Flash Fed Survey. What's happened is respondents have dialed back their inflation and their recession concerns, but both remain elevated and policy uncertainty is very high. Here's the data. We came up with 34 respondents, including fund managers, strategists, and economists, put recession probability at 41%. That's down from 53 in April, following the massive tariffs imposed by President Trump. But concern about a recession, it remains nearly double where it was in January. So 41 or 42 is pretty elevated. Compared to March, the growth outlook, a touch better at 1%. Still weak, though. Inflation forecast, a little bit better, but still high at 3.1% year over year. And unemployment, 4.5%, better than the prior forecast, but higher than the 4.2 right now. Forecasters have almost no confidence in their numbers. More than 80% said they were uncertain about the outlook for tariffs and uncertain about the economic impact of tariffs. The average respondent sees a 3.9% funds rate by year end, so about 2 quarter-point cuts, and another 2 next year, which is to say the Fed remains restrictive, or you can see there above that 3.3% terminal rate for a couple years yet. 70% of forecasters say proposed deficits were larger than previously expected, while a 36% plurality said this tax bill now working through Congress actually makes them more optimistic about the outlook. But about 2/3 say it makes no difference or actually makes them more pessimistic. So, Melissa, you know, it's not all better, but it's a little bit better than it was.
It's a little bit better, but with the asterisk that nobody's really confident in the little bit better either.
Yeah, no, it's a huge asterisk because people just aren't confident that, for example, some of the commentary talked about the 90 days. Like, what happens at the end of that? Can I make my forecast based on that? So they're not as confident. They're not as confident with the mechanisms, and they're not confident with the outcomes here.
Steve, great backdrop. I hope you're fishing later. Here's a bit of a curveball, but I know you're well suited to hit this one. Japan just had their worst bond auction since like 1987. And it's been concerning how quickly their yields are going higher. I know the Fed watches everything, but is this something you think that concerns them, or is this just a bit of an anomaly here?
Only as you might expect, to the extent that there is, it's a symbol or symbolic or emblematic of any broader systemic risk in global markets. I think the Fed was probably much more concerned about the recent decline in the dollar, along with the decline in bonds and decline in stocks. Those three assets moving together was a cause of concern, as well as some stuff that was going on inside financial markets that were reasons for concern before the president, backtracked on those tariffs on April 9th, and then again helping out on May 12th. So I think it's something worth watching. I'm not sure that there's a reason to think about there's an analog to that, what's happening here. But there is the issue, if we're going to try to reduce our trade, we're reducing the amount of money available from overseas to finance our deficits.